So the line of credit will be a certain amount. Now, that the other thing to note is when they get this money, of course, then they can use it for stuff. But a lot of times on the lines of credit, the amount goes up. And this is the beauty of why this is a good business. The amount goes up continuously. So for example, they can go up to 150% of the original loan.
Yeah.
So every year it goes up by the rate times the loan. So if the loan's 100 grand, the rate's 5%, that's 5 grand. So if the loan, the amount you can pull from it is now 105 instead of 100. Yes. And the next year it's 110 and so on. Again, wow. A little bit nuanced. We don't need to get into all that, but bottom line is, a lot of the ones that we see, they'll owe, 300,000 on a $200,000 house. And you wonder, how could that happen, right? So that's where HUD kicks in, and they are basically guaranteeing that loan. And the other thing you definitely have to remember, besides the, remember I talked about the 2 notes and 2 deeds, is the fact that there's a separate loan agreement. Okay, a loan agreement. Now, when you buy, and why is that different? That's a piece of paper that's not really your typical piece of paper that you see when you buy a note and mortgage, right? Because there's 3 parties now, right? You have the homeowner, you got the lender, and then you got HUD. A lot of times they call it the secretary. When you see secretary, by the way, that's HUD. So you got those 3 parties. So that loan agreement is talking about how those people interact, right? What's the association? What happens when this happens? And again, it's a lot of nuance, but that's an important document to try to get. Now, what I found is a lot of times I'll buy these things and the person that's selling them won't have that document. I like to have it. Can you do without it? Yeah, you could still, but a lot of, like the one I had in, I think it was in New Mexico recently. They really, the lender, not the lender, but the attorney really wanted that document to go, to prove their case or whatever. But we got through it without it. So, but it's really good to get. You're going to be more secure, feel a little bit better if you had that document. So that's another thing that's a little bit different from your paperwork, from your traditional, note mortgage. And then the last thing I want to mention is you definitely want to get a release of the mortgage lien, the HUD lien, which is the second lien, right? The subordinate HECM lien, which is the HUD lien, the Secretary of State, excuse me. And you want to get that release. Why? Because, it's a second loan. You want that released off. And HUD usually when they sell the loans, they just release it. They just sign a release and they record it. And it, it makes everything good. It satisfies that second lien. So those are the things you definitely want to keep in mind. Sure, go ahead.
I was going to say that most of the time when I buy those, that second is that's part of my collateral package is the release of that second lien. So, like you say, it's really important to get that, but that's pretty typical that comes with it. But make sure. Trust me.
Make sure you
make sure you're getting that.
Yeah, because again, that's something that's kind of unique, and that's why I'm mentioning it. People are used to, if they're buying notes now, they're buying, they're getting the note, the mortgage, the assignments, all those things you're going to get as well. That's all I'm going to be saying. But these are some of the things that are a little different. And like you said, Nathan, that's usually, part of the package, so to speak. But it might not be something everybody's probably not aware of, and you guys can chime in on this, but a lot of times there's reporting requirements, right?
Yes.
If you bought some notes from somebody, or if you went directly to HUD, of course, a lot of us don't do that, but if you did, then there's reporting requirements. Basically, HUD just wants to know what happened. We sold you this note. They would like you to sell it to an owner occupied, or sell it to maybe a charity, or maybe rent it to somebody, in such a way that it's what they really don't want is just to flip it, but they allow that after 30 days. So typically you got to try to sell it to someone for 30 days. After that, you could quote unquote sell it to an investor. But you got to report that. And again, usually the seller would contact you and ask you to report, hey, what's your status on this note or that note?
So let's dive into more of At what point does us investors get involved in any of this? Does this, as a note buyer, all this happened before we even get started, correct?
What do you mean? I'm not sure what you're saying.
So does the when they originate this note, this is all done with the borrower being aware of what's happening and things like that, right?
Right.
When we get involved in it, this stuff's all created for us to make sure when we're looking at reverse mortgages, it's done correctly. Would that be accurate?
Right. Yeah. Everything's done. You're just taking all the documents and saying, okay, just like you do typically when you buy a note, you got to make sure the assignments line up. You got to run title. But all those documents are there. You just got to, verify, right?
Gotcha.
Verify that they're correct. Make sure the names are the same. Make sure that, the addresses are the same. I've seen things like that. You make sure your chain is good to go. So yeah, all the stuff is, you're not having to do all this creation of all these documents we're mentioning. I'm just mentioning some of the ones that are kind of unique that you have to get from in your collateral package that you get from your seller.
Sure.
And you want to make sure, obviously,
And then there's one more part of that, Randy.
Go ahead.
Sure.
More important part of this is the servicing aspect. Do you want to talk a little bit about that? Because the servicing on these is a little bit different as well.
Yeah, good point. And then again, you can chime in. So basically, first of all, you got to find a servicer that will service it. Not all servicers service it. So what I found, I'll just tell you my experience. You can tell me yours. So the servicers that will not service it is like FCI. You guys heard of them, I'm sure.
Yep.
SN will not service it, as far as I know, unless they change. Who else?
And why won't they service
it? Won't service it.
What makes it that they can't service it?
Tuesday, I don't know. I don't. I think they just decided they don't want to do that for certain reason. Maybe there's reporting requirements or something.
Yes.
But there are services that do it, like Madison Management.
Okay.
And who else? BSI. Now, most of us don't use BSI because they're a little bit bigger, folks that have more loans, a lot of loans. I mean, thousands. But those are the two that I know. If you guys know of any other, let me know, because it's always good to know more. But who do you guys
I use Madison, and then I think part of it is their system isn't set up for it, because when you buy one of these, it doesn't continue to accrue interest the same way the regular mortgage would.
True.
And so I guess is that their servicing software just isn't set up for it, or they don't want to have to change their normal or something like that. That's my guess. I haven't gotten a straight answer.
No, I think that's correct, because I had another one. I think it was a simple interest loan. It's a daily. Oh my gosh, it was really a weird one, and FCI wouldn't do it, and some other ones wouldn't do it. But bottom line is, I think you hit the nail on the head that it's, remember, like Dave was talking about, it's they're giving, the lender is giving the homeowner money, right?
Yes.
So basically, it's not the homeowner giving the lender money, so everything's kind of reversed. So
let me just clarify real quick.
Set up for that.
Someone had a question, what do you mean by service? So in note space, we have servicers who act like a property manager, but in our space, when they collect payments typically from the borrower and they send it to the lender. So there's servicers who will not service a reverse mortgages, and some that do. And I agree. I think it's the way it's set up in their system. I'm sure Kevin probably is on here, and maybe you'll explain a little more about that side of it, but it's the idea of how the property manager in the world of real estate is handling this loan, because it's not a typical loan that's set up like a traditional asset. Sorry, go ahead.
Yeah, that's good. That's good. Yeah. So you really want a servicer with everything you do in notes. I mean, you pretty much have to, unless you're licensed in all these states, and forget all that. It's just too much work. So yeah, you definitely need a good servicer to work with you.
Absolutely. So now it's set up, ready to go. What makes something, why would anyone buy a reverse mortgage?
Well, I think one thing is people, especially investors that want to maybe get the real estate and rent it. or someone that wants to get the real estate and owner finance it and you know, create a note that way. You know, that's a great way to get a house at a discount versus going out and trying to find a house through the MLS, which, as we all know, there's not many, and they're very difficult to get at a big enough discount, right?
Sure.
It's a good way for maybe even a fix and flip. Like, for example, I have a couple I just got back, and I have to decide: am I gonna, you know, fix it myself, upgrade it and sell it, or maybe just upgrade it to a rental quality and rent it, or just try to sell it to another investor and it's a wholesale type thing. So it really depends, but that's a good way. That's one of the reasons people do it. I do it basically because I don't want the house, but I can't really obviously work with the homeowners because they're passed away. But what I can do is, if I do get the house, my preferred method is to sell it with owner financing. So
You bring a good point. We had Rich ask a question. Can you do a wrap note with a reverse mortgage property?
Well, it's not a wrap note because I own the property now, right? So when I foreclose,
Right.
I own the property outright. I have title. So I'm basically owner financing the house. So you have to go through, you know, owner financing, the Dodd-Frank things you guys talk about on, you know, watch these guys' videos on that. But bottom line is, I sell the house as owner financing, follow the wonderful rules, and it's basically a note stream, right? I'm getting monthly payments. I get a down payment, monthly payments, and at some point in the future, they cash me out. Like, actually on Monday, I'm getting cash out of a house in Cleveland, and so I'm getting. I think I sold that house with owner financing about 2 years ago.
Okay.
And now they're getting bank loan. I'm getting all my money, and I sold it at a you know, a decent price for them and myself. And it obviously was a lot higher than what I bought the note for.
So we're gonna, at the end of this call, we're gonna be going over what your best situation, your worst case scenario. So I'm looking forward to hearing that. And I want to be quickly understand the fact that most people are buying reverse mortgages, knowing the property's vacant. They go through the heir scenarios, make sure there's no heirs to collect it, and then they foreclose on it because the borrower is in default. It sounds kind of weird to say they're in default because technically they're getting payments made to them. But what are some of the triggers that cause that to be default?
Yeah, so it's really three things. If you look at the actual, you know, the triggers for default, right? In the, you know, if you look at the mortgage and the note and the loan agreement. So really, transfer of ownership. That's one, right? If the title gets transferred, they can call it due, just like a due on sale clause. Second is if the homeowner dies. Now, of course, if there's two people, like a, you know, husband and wife, or a, you know, their spouse, whoever it is, the other person can continue. That's not a problem. But if both parties pass away, or if there's just one, then they could accelerate the note and start to foreclose. The last one, if the homeowner moves out of the property and it's no longer their primary residence, right? As long if there's one person that's still there, that's fine. That originally signed on the note. But if someone moves out, no, they're going to kick it out and they're going to start to foreclose.